Have you ever wondered what happens when an entire sector of the financial industry collapses, leading to widespread chaos and distrust? It is a stark reminder of the delicate balance required to maintain economic stability. The savings and loan crisis of the 1980s and early 1990s had severe economic consequences, primarily resulting in a massive taxpayer bailout, significant disruption to the housing market, and widespread public distrust in financial oversight. It necessitated a fundamental restructuring of financial regulations. These dire outcomes stemmed from a confluence of factors, central among them being deregulation in the early 1980s, which allowed savings and loans, or S&Ls, to diversify beyond traditional home mortgages into riskier ventures like commercial real estate and junk bonds. This shift, combined with federal deposit insurance, created a moral hazard. S&L executives, knowing depositors were protected regardless of the institution's solvency, had an incentive to take on excessive risks to chase higher returns. When many of these speculative investments failed, and rising interest rates further squeezed their balance sheets due to maturity mismatch, the industry faced widespread insolvencies. Understanding the S&L crisis helps us appreciate the critical role of robust regulation and diligent supervision in maintaining financial system stability. It provides a historical blueprint for recognizing how the removal of adequate oversight, coupled with perverse incentives, can rapidly lead to systemic risk. By studying this period, we learn to identify potential vulnerabilities in financial innovation and to scrutinize mechanisms like deposit insurance for unintended consequences. The crisis ultimately led to the insolvency of the Federal Savings and Loan Insurance Corporation, or FSLIC, which had been tasked with protecting deposits. This necessitated the creation of the Resolution Trust Corporation, or RTC, a government entity formed to manage and dispose of the assets of hundreds of failed S&Ls. The RTC's monumental task involved one of the largest property liquidations in history, selling off assets worth hundreds of billions of dollars, often at fire sale prices, further impacting real estate markets. The total cost to taxpayers was estimated to be between $125 billion and $150 billion. In essence, the S&L crisis serves as a powerful historical lesson, vividly illustrating the profound economic repercussions of regulatory failures and unchecked risk-taking within the financial sector. Its legacy reinforces the importance of stringent oversight and prudent risk management practices to safeguard the economy from similar systemic shocks.